major part of their expenses. So I just explained here, expense is 10,000, but salary payable is 8,000. Why? Because there is a two difference between salary expense and salary payable. Because if my salary is 10,000, I don't receive 10,000. Why? Because tax is going to be deducted. Other taxes, other benefits, pension, all going to be deducted. So that's why tax expense is always greater than, sorry, salary expense is always greater than salary payable. So employee will receive salary payable, and rest of the stuffs are other government taxes, employee contribution to the pension account, this kind of stuff. Unearned revenue, which means you don't have this revenue. You are not right. You don't have the right to record that revenue. Why? Because you receive the sales amount in advance. Possession of your your goods are not transferred to the customer. So when you are not eligible to record the sales, so it is a liability until goods are transferred to the client or possession is transferred to the client. Until then, it will be treated as liability. Example, simple. On December 15, Southwest Airline collects $300 for a round trip from Dallas to Los Angeles. So remember, this is round trip. And they have received on, so their sale happened on 15. But did they provide the services? No. Right? On December 28, the customer flies to Los Angeles. So they provide half service, one-way trip from Los Angeles from Dallas to Los Angeles. So at the 15th, they receive cash. So can we call it as sales? Entry would be cash to unearned revenue or air traffic liability whatsoever. You can also write it down, unearned revenue here. Now, on 28th of December, half of this revenue, unearned revenue, belongs to you because you provided services. Sale executed. When sale executed, so $150 belongs to you. So unearned revenues mean liability decreases. So unearned revenue to revenue. Or in this case, because the head is air traffic liability, so decrease in liability means debit. And then sales or revenue. Right? So this 115, you understand how it, where it is coming from? Ella? Nam?
Yes.
Pinyo? Anthony, understand?
Yeah.
Okay, now let's move forward. So on January 4th, customer returns from Los Angeles to Dallas again. Now the next part also, their service is fully provided to the customer. So rest of the $150, now they already earned it. Again, the same entry, the unearned revenue to revenue or air traffic liability to liability. Here we go. Right? This is how you basically treat the unearned revenue in accounting process. Done? So we have illustration here. So just pause the video and try to solve it by yourself. And after that, we will be seeing the the solution here, right? So this is just for the the homework for you guys, just outer class activity. So after this class, I would be uploading this illustration. Just do it by yourself and then compare the answers. If you don't understand, please write us to our WeChat group, or you can also personal message me. I would be explaining this. So here would be the solution here. Now, current portion of long-term debt. Current portion of long-term debt. So normally it happened when you took a loan for a longer period of time, but with the understanding is that you will be paying them year on year basis. So current installment will be your current liability. Simple. We also call this current maturity or current installment for this name. So in current portion of long-term debt, you will pay the principal amount, and also there's going to be an interest treatment as well. Interest will be treated separately. Current portion of long-term debt will be treated separately as well. But you can also make a combined entry as well. So here we go. We have completed the first part of the current liability, that is current liability with known amount. But when current liabilities with estimated amount, how we are going to treat that one? So number one, when estimation has some kind of logic behind that, then we will record it. For example, if you recall, we talked about the treatment for uncollectible accounts, right? Because we don't know whether bad debts or customer will pay us or not, so we make a reserve. Similar treatment will occur here in warranty payable. We don't know how many customers will be applying for warranty. We don't know, but we will estimate it through some logical formula behind that. But what is contingent liability? In which we are uncertain how much will be the amount. For example, a customer filed a lawsuit against us, and we don't know how much is the settlement. Either it is $10,000 or $1 million. We don't know. Or if there is a natural disaster, how much loss is going to be. If, like in coronavirus, many employees, they loses their jobs. They loses their life. So they have to pay them. The company have to pay them insurance, life insurance. How much? How many people gonna die, and how much will be the expense? We don't know. We call this contingent liability, right? So for estimated warranty, we definitely have the accounting procedure, but for contingent liability, we don't. We only write down on the bottom of the balance sheet that if this liability happened or occurred, then we will pay, but we will not record it on the balance sheet because we are uncertain. We don't have any estimate behind that. So for estimated warranty payable, so normally warranty are given for 3 months to a year, that's it, or 2 years in case of fixtures and mobile phones like that, tablets. So company must record warranty expense in some period that business records sales. So if warranty happened this month, this year, it will be recorded on this year. If next year will be recorded on next year. Matching principle, simple. Contingent liability, potentially liability that depends on future outcome of past event. So there are 3 ways that we treat them. If contingent liability occurred, then we will record it. If it's likely to occur, if the things are very clear that we will lose the case against the customer, and the chances are that, higher chances are that the customer is going to claim $10 million. So you have seen Johnny Depp and Amber case study, right? Sorry, their case, divorce case, right? So if Johnny Depp wins, so they're like, everybody knows at the end that they are going to win. So you will record it. Or if the matter is undisclosed, it's still 50-50, then you will disclose it. It can happen, it cannot happen. But if the uncertainty is that if it will never happen, you will ignore it. You will not record it. Simple. So let's just see that. Here we go. So Black & Deckers with manufacturer's power tools made sales of 100,000 subject to product warranties. So assume that in the past year, between 2% to 4% of the products proved defective. So Black & Decker, they estimate that this year 3% sale will require repair. So what will be the entry? So simple. The warranty expense is going to be 3% of sale, but you paid it for cash or not? No. You make warranty payable or warranty reserve or something. Warranty payable, a liability. If not happened, then this will go back to the sales. We will close it. If happen, you will pay it. That's simple because it is estimated warranty. So liabilities with estimated amount will be recorded. Yes. Liabilities with not estimated account, we will see its occurrence, its likeliness, or its disclosure wise. We'll see here. So assume that defects add up to 2,800 and Black & Decker will replace defective products, right? So we create a liability for 3,000, 2,800 occurred. So what happened here? Simple. We charge the liability account. It means our sale is not disturbed. Our normal business operations are not disturbed because we in advance created a liability for warranty. And that warranty is going to be charged to the inventory. Simple. So balance of estimated key account still 200 left. Right? So this is the simple way of accounting for current liability with estimated amount. But for contingent liabilities, so we see the probability of occurrence. If it is probable, it means it is occurred. It will occur. You need to disclose that. In future or in near soon, we will be having a lawsuit against us, and worth is $10 million or $1 million. If you are reasonably sure that it is a possibility, 50-50 chance, you just disclose it. And if the probability is remote, you just ignore it. Simple. That's it. So today, this is the end of our lecture, but remember, we would be having the assignment of long-term assets, right? We didn't have the assignment of long-term assets. So I will be uploading assignment here. So let me also write it down. So those who are watching this, so they must know that there will be an assignment for right? An assignment for only the long treatment of long-term assets. Okay, class? I am not sure that I have uploaded or not, but I will be uploading again. Okay, so any question for this lecture? Ella, Naam,